Hi, everybody, and welcome back to EBnet Stream. We've had a couple of weeks of, let's call them volatile markets. That's probably an understatement. So I thought I'd reach out to Sanisha Packirisamy, who's the chief economist at Momentum Investments, and perhaps she could unpack some of the macros for us right now. So welcome to EBnet Stream, Sanisha.
Thanks so much for having me, Natalie.
So I'm a lazy reader, for example, which means I don't really read everything that I receive from people. And if this was pertaining to the economics specifically, what are the kind of 3 or 4 macro highlights you think people and investors should know about right now?
Sure, Natalie. I think we all became lazy readers in this age of info because it's just everywhere out there.
Too much.
So I think, like a couple of things just to kind of sum up where we are today since the start of the year. I think it's quite important to note the change in the US administration under President Donald Trump in his second term. And I think there was an expectation going into his second presidency that it would mimic a lot of the policies that he conducted under his first term. Of course, the big change here was that he went at China quite hard back in 2018, and that was really, the start of the big trade war between the US and China. And I think the big shift was that he's actually gone quite hard up against everyone in the rest of the world. And so, tariffs and protectionism have been a key theme for this year. I would say the second key global theme has been a continued rise in populism. So I say continued because I think this trend had already started before. Of course, we know in 2024 it was a very high election stakes year. So we hadn't had as many countries going to the polls like we did in 2024 in the last couple of decades. And the result of that was quite a big shift in terms of how citizens voted. So we came out of a cost of living crisis. People were very disgruntled with the case that food and fuel prices went up so sharply. We're not happy with immigration policies from centrist governments. And so we saw many people around the world voting for political parties that were on either side of center. So either going for that far left or far right. And we've seen that political parties have actually gone quite far across the spectrum. So you're not just looking at those centrist government policies that we've seen in the past. And I think that's also ushered in a bit of a shift in economic policies to date. And then, of course, bringing it back home. If you look at some of the changes here, we've had the operation under the Government of National Unity, which of course ushered in a huge promise of significant economic change. And I think there was quite a lot of disappointment since the start of the year, with economic growth still remaining quite pedestrian. So I'd say, looking at the 3 big changes, it's all been around the political discourse and how that's been influencing the economic agenda, not only globally, but we've also seen it here locally.
So I'm going to ask a question shamelessly. I hear this word multipolar world. What does this mean in an investment context?
Sure. So essentially what it means is that we've come out of a world that was typically bipolar in nature. So we had 2 of the great economic forces being the United States and China. And so quite a few, of the policies around the world were very kind of Western centric, and that was predominantly the US market. And then, of course, we had the emergence of China and Eastern policies coming on board. However, we've now morphed into what they call a multipolar world. And so that means that we're finding a lot more players entering that market. So it's no longer just the US and China that the world pays attention to. We're also listening to the voices of Brazil, Turkey, Saudi Arabia, even South Africa comes to the political course when we're talking about this. And so it doesn't necessarily mean that you have to have a very big chunk of global GDP to be part of this multipolar world, like Russia as an example, but it does mean you're quite important from a political standpoint. And so we're finding that many of these other players on this multipolar stage don't necessarily have a huge economic contribution to global GDP, but they are very important from a political voice point of view.
I also hear, thank you for that. And it kind of makes and cements another kind of thought that I have in my head, in my mind. Around this, the opportunities for Africa. So now I read another headline over the weekend about AGOA. We know tariffs have come in. Tariffs now make it, I'm going to say, essential to start talking to other consumers in the world that are not America. And I keep hearing about the potential or the opportunities for Africa. And there is a part of me that is an eternal optimist. And so part of me is quite hopeful. Is this unfounded?
Natalie, I think you've hit the nail on the head. It's never been as important as it has in the last while in history to be very focused on international relations and foreign affairs. So, this multipolar world that we're talking about, we are starting to see new geopolitical alliances starting to form from an economic, a political, even a trade perspective. And so that means it is ever most important for a player like South Africa to start talking to as many geographies as possible. So we don't want to put ourselves in a bucket and say that, we are only aligning with the Western alliance and we cut ourselves off from trade and economic and political opportunities elsewhere. Now, Africa has been, I think, quite a center of focus more recently, and we're seeing it coming through in terms of, America reaching out to certain African nations. We've seen China reaching out. And so as China has lost its trade conduit into the US, it's actually reoriented a lot of its exports into African markets. So there are about 5 countries there that dominate about 45% to 50% of what China exports to Africa. And it's no longer just, like the toys and the T-shirts, the traditional low value add manufacturing products that China used to produce, but they're now going into higher value add manufactured goods. So things like transportation vehicles, we know, China's massive boom in auto exports, and that's actually come through into Africa in quite a strong way. We've even seen players like Japan also approaching various African nations. And it's not just on the trade side, but it's also in terms of, extending loans to the African continent so that they can accelerate infrastructure spend. So I think you're quite right to be an internal optimist on Africa, because we are actually starting to see that is starting to morph as being one of the significant players as we continue to see China and the US battle over various geographies across the world. And we're starting to see many of these countries coming in. Now, of course, not to say that, Africa is going to be the next biggest investment opportunity on our doorstep tomorrow. There are still significant constraints there. We know that many African nations are still largely a commodity play. And if you have China, that's not going to grow at double digits in the next couple of years, and India is not quite as ready to take up that baton in its full volume perspective, that does mean that, Africa will still continue to lag on that basis. Another very big constraining factor for Africa is, of course, to have an extensive infrastructure network across the continent that can allow it to be a far more viable economic play in the world economy.
So that's interesting, and it raises something for me, and it's a conversation that I heard at this year's CFA conference, and perhaps you can unpack a little bit more for me as well. South Africa has resources, and Africa has resources that really are valuable in the new world of artificial intelligence and the infrastructure needed to power this, well, what they're calling the fifth industrial revolution. How possible is it that those resources and the capital we can raise with those resources stay in Africa or in South Africa versus, well, we sell ourselves to the highest bidder and all those resources move somewhere else?
I think the key here is beneficiation, and this is where South Africa hasn't done well in the past. So we've had the raw materials, we get it off the ground, but then we don't have that next layer of value add. And I think this is where we can promote more inclusive growth in South Africa, is to have that manufacturing capability. It's the same issue in the agricultural space where we produce the raw commodities, but we don't have the agro-processing facilities to actually increase employment in South Africa and just to get, growth up a notch. And so I think this is something that we will battle for quite some time until we have those resources developed in South Africa. And I think the same applies to Africa. Now, the issue of the raw minerals in terms of the rare earth materials, this is really critical. And I think this is where South Africa does have a competitive advantage. And you can see this in terms of how the trade negotiations went between the US and China. So while the US went quite hard at many countries around the world, we found that most of them buckled. Even a nation as large as the European Union walked away with a trade deal of 15%, and then they still said something like, this is quite a good deal that we got, even though a couple of months ago we all know they didn't have any tariffs applied. The one country that did actually retaliate was, of course, China, and that's because they held, no pun intended, the Trump card, and that Trump card was rare earth minerals. And of course, Trump acknowledged the importance of rare earth minerals in this new technology-driven world. And so they had to actually concede a bit here, and then we saw a bit of a de-escalation coming through. Even in terms of the tariffs that are applied to South Africa of that 31%, we know that roughly a third of our exports to the US are actually exempt, and a very big component of that are our platinum exports, as an example, because there aren't that many players in terms of supply to the global market. And I think there was also some recognition from the US administration that there are certain products and commodities that they won't be able to put a large tariff on, again, because of where they actually source these inputs for their own processes to develop technology.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally, for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
Sure, there's a lot happening. And so for the little investor like me out there, outlooks for South Africa, let's keep it local for a couple of minutes before we wrap up. But where would you be encouraging me to save or me to invest? What are your thoughts? I mean, markets are crazy. The JSE is crazy. The world's gone mad, and yet we're seeing these returns that are just, I think if you had told me on the 1st of January, I mean, I would have never believed you. So I'm not asking you to look into a crystal ball, but I really am. What are your thoughts around that?
Natalie, I think another thing I wouldn't believe is if I had to look at where the volatility measures are now in equities and in the fixed income markets, as low as they are, given the extent of things that have happened this year in the political and the economic space. So as you say, equity markets in particular have absolutely shrugged off all of the uncertainty, the ups and downs in markets, the whipsawing of tariffs that have come through from the US administration, and they've kind of just taken it in their stride. We believe that we say that local is still lacquer, so we would prefer being invested in South African markets rather than global markets. In the global space, particularly if you look at your developed market equities, and here we're thinking about US equities in specific, they've run quite hard, and it has been a very narrow-based kind of market returns that have come through from what we call the Magnificent Seven stocks. So those are more of your technology-driven stocks, and we think that that's really driven the recovery to a large extent there in the US market. If you bring it back home, on many metrics, whether you look at a price to earnings or price to book metric, South Africa still looks quite undervalued. And so that does suggest that even if you can eke out, reasonable returns, even less than what the market is suggesting for the next year or so, it does position South African equities in quite a good place. If you look at South African bonds relative to other developed market bond yields and other emerging market bond yields, we're actually also getting quite a good return there. We do think that SA bond yields take into account some political risk premium and some fiscal risk premium that's already embedded in there. Where we would start to not really look at so much as kind of the cash asset class, especially in South Africa, because we do believe that further out, and it may not be, the next couple of months, but we do still think that there's scope for further easing in interest rates. I mean, the one thing we didn't talk about is essentially the potential lowering of the inflation target on an official basis to 3%. And then, of course, if inflation expectations continue to adjust lower, and if we continue to see fiscal prudence in place, we could end up with further interest rate cuts. And of course, that won't be good for the SA asset class being cash.
Mm. You've hit on the one last question I wanted to pick your brains on, and that was last week's interest rate announcement, and the MPC kept it stable or standard in what was a split decision. So we've got interest rates and we've got inflation rates. What is the link between those two? You've already touched on some of it already, but what is the link of in those two? And like you rightly say, can we reasonably expect interest rates to come down, which is great for someone like me who's got heaps of debt, but not necessarily great for all the asset classes which us as investors hold?
Sure. So I think, let's take a step back and look at what happened with inflation globally and how South Africa responded. And so when we had that big push up in fuel and oil prices that caused the cost of living crisis globally, in South Africa, we didn't have a second round impact of that. Globally, we did. And so we saw that many workers across the globe went to their employers and said, well, look at what cost of living increases have done. We demand a higher salary. And businesses gave the higher salary, but in order to protect their profitability, also marked up prices. And so you had the self-fulfilling prophecy where you had a second round of inflation taking place. Services inflation went up quite substantially. Wage inflation went up in a big way. Now, locally, because we had such pedestrian growth and a lack of demand, we didn't actually see that second bout of inflation filter through. So food and oil prices came into the basket and caused inflation to go up, and then they washed out of the basket. And you actually saw that services inflation remained relatively muted here. Now, the link with interest rate policy essentially is to contain your inflationary pressures in the local environment. And what the governor of the South African Reserve Bank has often said is that low inflation can beget lower interest rates. High inflation can beget higher interest rates. Now, we know that inflation in particular hurts your lower income household because it hurts purchasing power. We know that low income tends to not have a lot of savings as a buffer in those certain financial conditions in the economy. And so if we can get inflation expectations to start adjusting lower in our economy, and we've already seen that the analyst community believes what the Reserve Bank has said because it has shown a very high level of credibility in the past in order to contain inflation pressures. And if we start to see that trade unions and businesses also adjust their expectations lower, and of course, if we have fiscal policy also doing its part by instilling prudent fiscal policies in the economy, it is likely that we could see inflation coming down over the next couple of quarters, and that would then allow a little bit of breathing room for monetary policy for those rates to actually adjust a little bit lower. And as you say, that would significantly ease the burden for those debt-laden consumers. We've already seen that the 125 basis points worth of interest rate cuts that we've had from the Reserve Bank so far in this cycle have already alleviated that pain point for the debt-laden consumers, to an extent that we actually have, more consumers that are not indebted in terms of their arrears figures that we've seen from the National Credit Regulator. So that data is already starting to look a bit more positive. And of course, if we can continue to see further interest rate cuts into 2026, this will alleviate the debt burden even more for consumers, freeing up a little bit of their purchasing power to go back into consumption spend. And then, of course, that does become quite a big boost for your economic growth outlook.
Thank you for that. And one last cheeky question, and thanks for that great explanation. One last cheeky question. You walk into the casino, you've got a handful of chips, you walk up to the roulette table, and South Africa or not South Africa, which block are you putting it on?
Well, South African equities, yes. As the local is lacquer. And I think why this sometimes confuses people is we're sitting in an economy that's, barely growing at 1%, but yes, the SA equity market is powering ahead. But if you had to look into the SA equity market, quite a lot of the earnings actually come through from offshore. And if we look at where it's coming from, not a lot of it is exposed to US tariffs. So that does actually give us a little bit of a leg up on SA equities, even in an environment where the SA growth dynamics are still quite poor.
Sanisha, it's always a pleasure chatting to you. Thank you for taking the time for us today. I appreciate your input.
Thank you so much, Natalie. Take care.